Hello friends, I am Manoj Goyal from the Wall Street School. We have been training students in the core field of finance since 2009. Friends, with our experience of teaching thousands of students in the field of finance, we have observed that one of the most important concepts that students usually miss out on is equity research. That's why we have prepared this video to explain what equity research actually is and how you can build your career into this field. In this video, firstly, we will give you an outline of what equity research is. Then, we will briefly explain various sections of equity research report. Then finally, we will be taking a practical example of Aarti Industries to explain how to do equity research in step-by-step manner. We will be marking sections into this video, so either you can watch complete video or you can directly move to the tutorial part. So let's begin.
Hello everyone, welcome back to the channel. I hope all of you are fit, fine and safe and are doing amazingly well. Few months back, I've uploaded a video on the topic what is equity research, and that video got very good response and many questions were asked. In that particular video, I explained meaning of equity research, the job roles that you could be looking for, the skills required to get into equity research profile, the salaries and top recruiters, right? In today's video, we'll be talking about how you can do a particular equity research. How do you analyze a stock? I won't be focusing much on financials in this video because I have already prepared a video on how to do financial analysis. I'll attach a link to that video in the description. In today's video, firstly, I'll be helping you to recall very quickly what exactly was equity research, how do these equity research firms makes money. Then we'll be talking about sections of a particular equity research report. Any equity research report is divided into 9 broad sections. We'll be talking about them. Sir, why are we talking about them? This helps us to think in a particular structure. Then I'll be telling you how do you do that equity research or how I do at my end. And then I'll be showing you one practical example. A 20-30 minutes video I've prepared in which I am doing a research on a company called as Aarti Industries. I'll be sharing that research with you. Okay, so let us start. Firstly, what is equity research? We have already seen this in the previous video. Just a very quick summary of that. So see, equity research people basically gives recommendation whether you should be buying a particular share or you should be selling a particular share, right? Then who do they work for? There are two types of equity research analyst. One is buy side, one is sell side. Buy side means they do the research for the houses who have funds, and on the basis of their research, these houses invest the money. Like mutual funds, they will work for mutual funds. Mutual funds will hire some equity research analyst. They'll do the research and then suggest the mutual fund whether they should buy and sell. Hedge funds, pension funds, some big corporates, HNIs. Similarly, we have sell side people. Sell side people are basically investment banks and brokerage houses who are recommending these investment products to their client. Now the question arises, why do they do so? Because they want to beat the markets. See, ultimately your aim is to beat Nifty 50 or to beat Sensex. So by actively investing in stocks, you want to beat the passive returns, and that is the whole purpose of doing equity research. Otherwise, you can simply park your money into index funds and they will generate money for you. Now, how do these equity research firms or divisions makes money? They don't make money by selling the reports. They make money by commissions. So like a research division will recommend to buy and sell a particular stock. The client will buy and sell that particular stock, and using when a client is buying or selling that particular stock through the brokerage arm of the particular firm, that brokerage arm will be generating commissions. So equity research division is a cost center role. Brokerage arm will generate commissions when a client buys or sells based upon your recommendation, right? This is broadly how a typical equity research department works. Now let us talk about sections of equity research report. Broadly, there are 9 headings in a particular equity research report. The first one would be eye catchers. So there will be investment summary, recommendations and target. If this interests you, then you can see stocks last performance, last 1 year performance, last 5 years performance in comparison to index, because ultimately your aim is to beat the index, right? Beat the passive investors. Then you will be giving some basic information about the company. And if this is really interesting, the person who is reading that report will continue reading this, and then you talk about the business model of the company and future expected performance, how the future for this company can unfold in the future. Then you will be talking about industry in which that company is operating, and the sector in which this company is operating. Once you tell about the sector, industry, and the business model, you talk about the valuations and give details about the valuations. You do valuations using DCF, relative valuations, and then give a summary of it, like a football field analysis. Then you give snapshot of the company's financial for last 2 years, 3 years, as well as you give the projection for next 3 years or 5 years. Then you talk about the management, you talk about the governance, and if there are any issues with the company, you highlight those also. And then you make investment disclosure, right? Maybe your company would have invested in that company. So you tell, we have some interest in the share, or you tell, we don't have any interest in the share. It is not in our investment portfolio, right? I'll show you one equity research report. This is relatively old equity research report, but I have kept it purposely a bit older. This is 2013 equity research report on TCS. Now it feels nostalgic to see TCS at 1500 rupees. And the buying, the rating was neutral at that point in time. So see, they are talking about the current market price, they are talking about snapshot of the financials, and then valuations. Then they are giving snapshot of their performance, and they are also making some projections. Here they are talking about the future of the business, they are talking about the growth of the business. If I scroll down, I'll just zoom in. Changes in estimates. Then they are talking about estimates, what they were earlier, now what they are. Then valuation summary. Then the top line growth. You can read this report. I cannot read the entire report in this video. They're basically talking about the entire P&L one by one. So sales, then cost, then margins, everything is discussed, right? Pros and cons of the company. And if I scroll down towards the end, you will see here, just a second, you will see here, they are making disclosures, right? They might be interested in the company. They might have invested in this company, right? Analyst certification is given. And then they are talking about, okay, Motilal is, so I'll have issued this report. This is broadly the report. If you want, I'll attach a Google Drive link for this report. But broadly, I want to take the structure. How do you analyze a particular company? In this particular manner, you can analyze a company. Let me give you a better approach to analyze a company. How do you do this equity research? So there are two approaches. Either it is top-down approach or it is bottom-up approach. Top-down approach, you see global economy, then you talk about Indian economy, then you talk about the sectors in the economy, and then specific company. This is top-down approach. And bottom-up approach, you start from the very ground level, you see a company, then you think whether the sector is going to perform or not. So you talk about the tailwinds in the sector, then you see global economy, you see Indian economy, and then you see the global economy, right? So I particularly prefer this approach. This saves lots of time because see, this analysis is going to remain same. Only you have to select a good sector, a well-performing sector for next 5, 10, 15 years and a good company within that sector. So it really saves my time. This is how I approach. You could have alternatively this approach, bottom-up approach, right? Now, let me tell you how I approach this research of Aarti Industries. So firstly, I went to the website and downloaded every possible document. So what are the possible documents that you have downloaded? Okay, let me tell you this. Let me get rid of. Okay. So first of all, I downloaded maximum possible equity research reports, right? For doing my research, either I can start digging from the ground level or whatever research other people have done, at least to get understanding. I'll download equity research from any source possible, right? So I'll show you some sources also. So there is a firm called as Prabhudas Leeladhar. Okay. You can go to their latest report and you can download reports from over here, right? Whichever company you want. Suppose we want Aarti Industries. So I will write here Aarti Industries and we'll click on search. So first of all, you should always read the initiation report. Initiation report is when the equity research house starts to analyze the company and then there are updates. So they are like, then there are updates. They recommend buying, selling, accumulating, downgrades, upgrades happening. But you should always start from initiation report. So you can download these reports, you can Google, and you can get various equity research report from various houses. If in case you want to download this, you can click on this PDF. It will ask you for OTP. So click on this guest user, submit in your mobile number, click on sign up. After you receive your OTP, put in that OTP over here, and the report will be downloaded automatically. Right? It's very easy, very easy. Download these equity research reports from multiple sources. I personally recommend this, Prabhudas Leeladhar, and then HDFC Securities. These 2-3 sources are good enough. After doing that, after downloading these equity research reports, download or read about the latest news articles of the company. Just simply go to Google. I'll just go here. We'll write google.com, and here I'll be searching about Aarti Industries. Okay, because this is our subject company now, and simply click on news, and then whatever are the news articles, read last 6 months, 1 year of news articles on this company. Right? After doing this, go to their website and download all the possible reports from as back in time you can go, last 5, 10, 15, 20 years. I went to Aarti Industries website and downloaded all of their annual reports, con calls, presentation, quarterly updates, management presentation, everything possible that was given. I'll show you also. So like I've downloaded research reports, then I've downloaded annual reports, con calls, investor presentation, some miscellaneous presentation, like let's say con calls. I've downloaded it for all the years and have actually read this, right? So I went to 2017, read all these things and marked what are things that interest me as an investor. Okay. After doing this, spend some time to understand company and its dynamics. Like when you talk about the legendary investor Warren Buffett, he also have 2 boxes on his table: understandable businesses and non-understandable businesses. Spend 2-3 weeks reading about the company from various news articles, these equity research reports, and then ultimately annual reports, investor presentation, and con call. If you are able to understand the company, understand the industry and the dynamics, well and good. If you are not able to understand, please do not proceed ahead, stop. Look for some other opportunities. But if you are able to understand the company and all, now start developing your thesis. Investment thesis. Why I should be investing in this. After developing your thesis, test your thesis on the basis of numbers. Do some valuations, calculate the fair value of the company. You can do DCF or you can do relative valuation. I am personally in favor of DCF analysis. Some people tend to do relative valuation. It is much quicker than DCF, but still both of them have pros and cons, right? And then once you are satisfied that, okay, I can get this share at below the fair value, then act fast. If in case you have an opportunity and if you don't act, it's like having no opportunity, right? And after you invest, after doing this much amount of research, investing 2-3 weeks, then have patience. Then there is nothing you can do. Just keep yourself updated quarterly, every month. Just spend maybe one odd day when you update yourself about your investment portfolio. Very simple process. You don't need to watch screen every other day. The company is doing business, right? The company is generating cash flows. Once you are owner of the company, once you buy shares of that company, you don't need to watch charts every other day unless you are a trader. If you are a trader, please go ahead, do that. But if you are an investor, just keep yourself updated about what is happening in the company rather than updating yourself on the price of the shares, right? Okay. With that being said, now let us move towards the equity research or the research that I have done for you just to make you understand how you do a particular research. So let's move towards that part of the video. In today's video, we are going to try to understand Aarti Industries. Basically, we have done research at our end and I'm just presenting you so that you can learn how do you research all these things, right? So let us start. So first of all, we need a thought process, a lens to understand how a company operates, right? Where you should be exactly looking at. So we'll be talking about the thought process to understand Aarti Industries. Then we'll be talking about process chemistry and the sector, because we'll be like Aarti Industries belong to specialty chemical sector. We need sectors understanding so that we can understand company in a better way. We'll be talking about history of the company and the introduction to their business model. Then we'll be talking about their product lines, the future plans which they have to offer, and their like the financial statements for last 10 years, right? In this video, I am not going to talk about valuations and their competitors. So let us start. First of all, let us talk about the thought process. So the first thought process that you need to understand Aarti Industries is operating leverage. Sir, what do you mean by operating leverage? Operating leverage means presence of fixed cost in your total cost of production. Suppose currently I am producing 100 units and say my rentals fixed cost is 1 lakh rupees for the premises in which I am producing all these things. So my fixed cost per unit will be 1000 rupees. Now, because of some reasons, I got a very big order of say producing 10,000 units. Still my rentals will remain same, my fixed cost will remain same, but my fixed cost per unit will come down to 10 rupees only. That is, my production will become a lot cheaper if my cost is fixed and my sales is expanding. This is called as operating leverage, right? So it is generally recommended in corporate finance. If you have a business that is operating into cyclical industry, you should keep your debt commitments, that is financial leverage, at the lowest level, because you don't know how long slack period you have to go through. At least you have to keep on paying the interest during that period. Then you have non-cyclical businesses, that is like FMCG industry, in which there is consistent generation of cash flows. So you can afford to have very high leverage, because ultimately you will be able to pay it off using the cash your business is generating. And then you have shallow cyclical businesses, in which there is slack period, but slack period is not that long. Say a cyclical business will have 5 years of very high growth phase and then 5 years of a slack period. A shallow cyclical industry will have say 1 or 2 years of slack period and then 1, 2, 3, 4 years of very high growth phase. So in shallow cyclical businesses, we generally recommend you should have very high operating leverage and low financial leverage. That is, your debt should be at the lower level and your operating leverage should be higher level, because as you expand, your profit margins will increase and you will be expanding relatively quickly than your cyclical businesses, right? So you have to understand this model. In fact, Jeff Bezos in his 2002 Amazon letter focused on this thing called as operating leverage. Let's read this together. See, he said this: one of our most exciting peculiarities is poorly understood. People see that we are determined to offer both world-leading customer experience and lowest possible prices. So they want customer experience to be the best in the class and they have to do it at the lowest prices possible. Then only they could survive. And this is paradoxical in nature. If you want to offer the best customer experience, you cannot do it at the lowest prices possible, right? This is where traditional stores suffer. He's saying we are not suffering from this. We can take advantage of this because we are an online business. Traditional stores suffer this problem because if they want to give very high or good quality of customer experience, then they cannot offer the lowest prices, and then ultimately some people will go away from them and will buy it from their competitors, and ultimately their profit margins will decrease, right? It is not possible for traditional stores to offer both the things. These are dichotomous things. But for Amazon, Amazon.com is trying to do the both. The question arises, how? The answer is, we transform much of our customer experience like unmatched selection, product information, personalized recommendation, and other new software features into fixed expense. He's saying, see, we have to do everything online. Product recommendation, best prices possible, unmatched selection, product description. We can build into our software. This is going to be our fixed cost. Once we built it into our website, this is going to be our fixed cost. Now the customer will be getting the maximum information and the best prices possible. And for us, it is a fixed cost. Now, if I'm serving one customer, then also my cost is fixed. And if I'm serving, say, 1 million customer, then also my cost is fixed. So my fixed cost as a percentage of sales will shrink rapidly, and this will help us to expand our margins, right? So to get benefit of this operating leverage, you need expansion in sales and economies of scale. Expansion in sales will happen only in the industry in which there is tailwind. Up to a particular point you can do by some marketing and all, but ultimately you need tailwinds in the industry. And specialty chemical, in which Aarti industry is operating, is a sector where there is lots of tailwinds. Tailwinds is coming from China, tailwinds is coming from the Western countries, and the domestic consumption is also very increasing very rapidly. So another thought process that we need to understand is BCG metrics, right? You can analyze any business, or any business can have these kind of four subdivisions, or you can see any business as any of these. So cash cow, like for Reliance, cash cow is petrol. Low growth but high market share. So it's growing relatively slow, but its market share is really high, and it keeps on generating cash. Like it is a cash machine for Reliance, right? And whatever cash is being generated by them, they can reinvest into other ventures like Geo, Reliance Retail, Reliance Media, and so many other things that they do. You have some businesses called as star businesses, and you should be especially looking to invest in these businesses. So what is a star business? A high growth rate and high market share business, which is growing really fast and the market share is really high, right? The third one is called as dog business. Dog business means it is growing really slow and the market share is also really low. It's growing slow and the market share is really low. That is, there's no point of being in such businesses, right? Just liquidate them, divest from them, just let them go away. In fact, Aarti Industries did that. They had a division called as Home and Personal Care, which was not growing as its pharma business, as its specialty chemical business. They let it go. They have disinvested from that. Now you have some high growth, low share business. This is called as question mark. Tomorrow, if high growth gets converted into high market share, they will become star businesses, and star businesses ultimately get transformed into cash cows, or they might also become dog businesses. This is where opportunity lies, right? So Aarti Industries have two star businesses. A business of specialty chemicals in which they are operating. Their market share is really high and they are growing much faster than its peers, and growth rate is also really high. So technically it is a star business, but one might argue that it is a cash cow for them, because whatever cash they are generating from these business, they are reinvesting into other businesses. They have also one segment called as pharma sector. In pharma, like the growth rate is really high, their market share is not higher, but growth rate is so fast, it might become star business going ahead in the future. It is currently in question mark category, but when one might argue, since the growth rate is slow, so fast, you can move into like this star business category, right? Market share could ultimately increase. So this is the second thought process that you need to understand while analyzing Aarti Industries. Okay. Now let us move ahead and let's talk about process chemistry. Aarti Industries is a company that is dealing in benzene and its derivatives prominently, right? Toluene also to some extent, sulfuric acid also to some extent, pharma sector also to some extent, but majorly they are producers of benzene. Benzene is an hydrocarbon that is derived from crude oil, right? So how do I produce benzene? In total, there are 3 processes. We don't need to understand the process. I'm just telling you, you take crude oil, you heat it, it creates benzene. This is called as cracking of crude oil. You take crude oil, you convert into naphtha, and from naphtha you can derive benzene. This is called as reforming naphtha. And then you take toluene. Toluene is also derivative of crude oil. You convert toluene into benzene, and this is called as hydroalkylization or toluene disproportionation, right? We don't need to understand or remember these names, but as a person who have researched on all these things, I felt sharing all these things, because maybe I am not from chemistry background. The person who is watching this video may be from this background, right? So you'll be able to connect better with the company. Now moving ahead, let us talk about the specialty chemical sector, the entire industry, right? So firstly, specialty chemical, what do you mean by this? So these are the chemicals which are really expensive, so high value and low volume. They are not adding any new features to the product they are mixed with. They are just enhancing the performance of the currently existing product. When you mix, say, specialty chemical into a shampoo, the foam it produces increases drastically. So specialty chemical is just increasing the performance of the shampoo. Okay. Now, specialty chemical is everywhere, used everywhere. From agrochemicals, colorants, paints, surfactants, water treatment, textile chemicals like dyes, flavors, fragrances, personal cares, polymers. It is everywhere. Chemicals are everywhere, right? They are basic building block of the product that you are trying to manufacture. Global specialty chemical that is currently valued around $800 billion is expected to reach $1 trillion by 2024. That is, it is expected to grow around 6%. Indian specialty chemical market, that is 10% of global specialty chemical market, is growing around 12%. Earlier it was growing around 10%. Now the growth rate have increased. So India is growing twice the world, right? And India, like the entire chemical sector of India, more than 50% is specialty chemical. So out of entire chemical sector of India, more than 50% is specialty chemical. In last 2 decades, what was happening? See, the westernization is now getting transformed into easternization. That is, the developed countries are losing their production supremacy to emerging markets, and China was the major beneficiary of this, right? But now in last few years, the environmental laws in China have become much more strict. Earlier it was growing around 20%. The CAGR growth rate of specialty chemical market in China till 2013 was around 20%. But because of stricter environmental laws, it is only around 4 to 6% now. So India is looked as an alternative to China. So we have tailwinds from China, number one. Number two, because of easternization theme playing on, we have tailwinds from entire world, and along with it we have domestic tailwinds also. That is, global per capita consumption of specialty chemical is around $100, but Indian per capita consumption of specialty chemical is only around $23. So this have at least potential to grow 4x. So tailwinds from everywhere in this industry. This can grow at a very rapid pace in next few years, right? Let's learn something about Aarti Industries business, its history, and its the business model, right? So let us start. So Aarti Industries is one of the top global players of benzene chain. It is one of the most backward integrated specialty chemical player in India. What do I mean by this? I'll be explaining in when we move towards the product segment. Then they are currently operating into 2 divisions. Earlier they were operating into 3 divisions. Majority of the its revenue is coming from specialty chemical. They also operate in pharma segment that they have announced that they will be demerging because it needs its own special attention because it's growing very fast. And then home and personal care was a division that they have demerged now. It is listed as Aarti Surfactants, right? Okay. Now, like, they are among the top players in the world. They will rank first or second or third or fourth. So whatever products they offer in the products they offer, 75% of its product portfolio, they are among the best players in the world. 1, 2, 3, 4 ranking, right? And because, see, what is happening, they take benzene and they derive many products from this. So because of that, they are backward integrated, and economies of scale also operate because you can produce this product and use it for production of this product. You can produce this product and use it for production of this product. So economies of scale also play in their favor. Economies of scale, that is, this expansion of margins, operating leverage will start playing in their favor, and they are not shying away from investing into the business. If there is a scope for expansion, they have funds available for it and they don't shy away. There are many companies who shy away from expanding because they don't want to take risk. Aarti Industries is something like the management of Aarti Industry believes in taking balanced risk. They've invested around 2200 crore rupees in between 2014 to 2018 in creation of new plants, new facilities, introduction of new products, right? So they are basically becoming one-stop solution for majority of their clients. You can read here, they have around 1100 clients, 700 global and 700 local and 400 global. That is, there is no dependence upon one single customer. They offer more than 200 products, right? And they are manufacturing, like when they started, from that point in time till now they've expanded into 20 different plants. And the units they have for pharma sector. 2 of them are US FDA approved and 3 of them are WHO approved, right? Now let's read more about Aarti Industries. They are operating on the 6th level derivative of the benzene chemistry. Now they are getting expanding into toluene also. So what happens when you operate on 6th level derivative? See, benzene, if you are only using benzene and producing say one derivative of it or two derivative of it, let's say NCB, nitrochlorobenzene, you are basically a commoditized company. You're not adding value to the client. If the price of benzene increases, your production cost will increase. In case of Aarti Industries, they are able to pass on this production cost, increased production cost to its customer. So this is something playing in their benefit. But if you are producing many things from this benzene, what will happen? You are becoming one-stop solution for the client. He might need benzene, he might need NCB, he might need some other thing that you're deriving from NCB. He can take it from you. And since you are doing this in bulk, you are the lowest cost manufacturer also, or among the lowest cost manufacturer. So he's intrigued to buy from you. And since he is buying one or two products, why not second, third, fourth, fifth product? So you create a ecosystem around the client. Now he cannot escape you because you have everything that he wants, right? Now, companies like expanding into other segments also. From benzene derivatives, they are now also expanding into toluene derivatives and pharma sector. In fact, like whatever India's requirement is of nitrochlorobenzene, 70% of the entire nation's requirement is fulfilled by Aarti Industries. Such a mega manufacturer, right? And we are talking about their capital spending. I was saying that they are not shying away. You can see, like each year their capex is expanding from 500 crores, 600 crores, 800 crores, 1200 crores, and 1300 crores. So their capex is expanding. That is, they see opportunity of growing revenues. They see opportunity of making more wealth for the shareholders, right? And I said that they are into they are into shallow cyclical business. Why they are into shallow cyclical business? They are producing specialty chemicals. 60% of the chemicals they produce are used in essentials like agro, pharma, FMCG. So sale of food will not stop. Sale of shampoo will not stop, irrespectively how bad or good economy is doing. 40% of their sales goes into discretionary products like dyes, pigments, printing inks and all. So they are like, this is much more cyclical in nature. This discretionary products are cyclical in nature. Essential products are non-cyclical in nature. So all in all, they are into shallow cyclical business, right? Now let us move ahead and let's talk about their management. You can pause this and you can go through this. I just want to tell you their management, their board of directors is very balanced. First of all, the most important thing to look for in the management of this specialty chemical company, the promoters, the people who are really operating this company should be technocrats. That is, they should be having understanding of chemistry, right? You and I cannot operate such company because at least I don't know chemistry. You might be aware of it, but I cannot operate such company until unless I have knowledge of this chemistry, right? So like you can see Shri Rajendra V. Gogri, he is a technocrat. You can see the second generation. Like the second generation is IIM qualified. The second generation is IIT qualified. And they are looking after their responsibilities very well. They have bankers in their board of directors. They have people who have worked with companies like Cipla, Lupin and have like 30-40 years of experience into pharma sector. So they are focusing on pharma. The second generation, succession is not a problem. And they also have that is led by the first generation technocrat who has been around the company from the very beginning, right? If you want, you can pause this. Okay. Now moving ahead, let us talk about the timeline. Just to show you, like one thing that I want to highlight in this timeline is they are continuously expanding and they are delivering on their promises. That is, they started in 1984 with one plant. The production capacity was 1200 ton per annum. In 4 years, they expanded the capacity almost by four times. Then they expanded into newer chemistries. Then they expanded into pharma and then expanded the production capacity. Then they have again expanded into pharma and then newer chemistries. Like going ahead, in last couple of years, you can see their production capacity have reached around like from 1200 tons per annum. This is 175 kilotons per annum. Kilotons per annum. So you can see how exponential their production capacity have expanded, right? They became global giants, right? So this is something that I want to focus, like I want you to focus on. They are continuously expanding into what they are best at and trying new things. They might fail on the way, but all in all, they don't seem to be shying away from expanding and taking calculative risk, right? Okay, now let us move ahead and talk about the products and their sixth level chemistry that we are referring, integration, right? So they offer like benzene chain, benzene, they have NCB, DCB, and PDA. I don't want you to go into the chemistry of it. I want you to understand from NCB, they produce this MCB. This MCB is used to produce PNCB and ONCB. This is basically, firstly, they chlorinate it, then they nitrate it, and then they ammonolysis it. So basically, you are using one product and creating lots of value addition from that, right? And they have reached sixth level of chemistry. So this is like first, second, third, fourth, fifth, sixth. How backward integrated they are. Not only in NCB, not only in DCB, not only in PDA, in all segments they are offering products, right? We don't want to get into all these terms because we are not from chemistry background. We won't be able to appreciate it, right? But I want you to understand overall their product portfolio is very, very deeply integrated with one another. They are expanding into toluene also. So for toluene, they are doing nitration, hydrogenation, and then some other chemistry. They also have some sulfuric acid value chain. That's not very significant for them, so I'm not focusing here. They are amongst the top 3 players of NCB, top 3 players of DCB, dichlorobenzene, and the only players of nitrofluoroaromatics, that is helix chemistry, right? In India. Okay, now let's talk about their pharma segments. Their revenue is coming from 3 things: intermediates, APIs, and xanthine derivatives. Now automatically the candidate asks, sir, what is this xanthine derivative, API, and intermediates? Please explain to us. Before doing that, I just want you to focus on this. They have 5 production capacity, 2 R&D research and development facilities, and they have 52 patents filed. 13 of them are awarded. Some of them might have been rejected. Some of them might be under the process, right? Okay. Now going ahead, let's understand these terms: API, intermediates, and xanthine derivatives. First of all, API, active pharmaceutical ingredient. See, when you take a medicine called as crocin have something called as paracetamol, right? This paracetamol is not crocin. This crocin have 2 things. The first ingredient, the inactive one, that is like all the other substances that will take the medicine to your stomach. Then the medicine will dissolve and paracetamol will kick in. So API is this paracetamol, active pharmaceutical ingredient. Any medicine have 2 ingredients. The first one, the inactive one, and the second one, active one. Active one, paracetamol, is the example of API. Intermediates. Intermediates means, see, to produce API, you take raw material, whatever chemicals are required. To reach API level, you take it through multiple chemistries, right? Now, if anything is raw material but not converted into API, like over this stage, we'll call it as intermediate. So you can create APIs and you can use raw material and create intermediates and sell it to some other companies also. And xanthine derivatives, xanthine is basically used in your energy drinks and treatment of some diseases. Now let us talk about the competitive advantage the Aarti Industries have in comparison to its peers. The first and the biggest advantage they have is the backward integration. If they are producing any API, they have capacity and they produce its own intermediates. Like they are not using someone else's intermediates and then producing APIs. Intermediates are semi-prepared APIs, right? Building blocks of API. Right, so this is the biggest advantage. Along with it, like they are working with several global innovators for manufacturing APIs for them. They have some USFD approved plants and all. That's perfectly fine. But backward integration is something they have, which other competitors many times don't have. So what are the services they offer within this pharma sector? So they offer CRO and CMO facilities, contract research organizations and contract manufacturing organization. Let us understand this CROs and CMOs. So see what happens. Like whenever you want, suppose this COVID happened, right? Someone invented a vaccine of COVID. Someone invented a vaccine of COVID. It went into clinical phases, then it got approval, and then like you and I got the vaccine. So what happens? First of all, you do basic research. Whenever you new virus is found, you start doing research on it. You make early discoveries, and then you move into preclinical trials. In preclinical trials, you are doing in vitro or in vivo testing. Basically, you are testing like you are treating that virus in test tubes, or you are treating those virus by injecting the discovery that you have made, the drug that you have created into animals like guinea pigs, like rabbits, like rats. So once it is successful, from preclinical you move to clinical development. That is from testing the drug on animals and in labs, you test it on humans. You move to phase number 1, that is you test it around 100 people in a very limited like controlled environment. Then if it is successful, the probability historically be in around 63% from moving phase 1 to phase 2. You will test it around say 1000 people, phase number 2, and the probability of moving from phase 2 to phase 3 is around 30%. The probability decreases drastically for moving to phase 3. But if you have reached phase 3, like you will be testing it around 5000 humans, new drug application like approval, it is around very high 85%. After successfully getting your results in phase 3, you move to NDA, that is new drug application. The probability is around 58%. And after this, like if you have tested this completely and getting approval from FDA, the probability is really high, around 85%. So overall you see from phase 1 till getting approval, the probability of success is very low, 9.6. Only the last stage, after doing test on 5000 people, if you are really confident, there's a very high probability, around 85% historically, that FDA will approve your drug, and then it will be commercialized. That is, bulk manufacturing of drugs will be done and will be injected to the suffering like the patients, right? This is the entire phase. Now there is a problem in this phase. The first one is you spend so much of amount in research and there is a only 10% success rate. So the innovators globally, like Pfizer, they don't want to invest so much time on research, or they don't want to invest so much money on research. What they do is they outsource it to someone to research for them. This is called as CRO, contract research organizations, contract research opportunities, right? You are doing research for some global giant, global innovator. CMO, contract manufacturing organization. After getting FDA approval, these global innovators don't want to invest their time into production of these things. So what they do is they outsource the production to some other companies, that is called as CMO, contract manufacturing organizations, right? So like a good thing about this kind of business is, if a technology is transferred to you, if you have signed your like if you have done handshake with some global innovators, and you will be among 1 or 2 3 like manufacturers around the world of a particular drug, it's very difficult for them to take that technology back from you. Once you start the manufacturing, once you set up the plant, you will continue doing that until unless that virus have exhausted completely. So it's a very good business, right? Once a deal is done, it's done. Like there is a very low probability it will be like going away from you. Okay, coming back to this discussion, this is just a slide for you to see. Out of their total 20 plants, 15 is specialty chemical, 5 is pharma. Their total revenue, 44 is coming from exports, 44%, and 56 is coming from domestic market. Where they are exporting: North America 20%, Europe 27%, China 14%, Japan 7%, and rest of the world 32%. Right? Moving ahead, what are their future plans?
Okay, now let us talk about their future plans. See, whenever I'm analyzing future of any company, I'm talking about two things, or I'm observing two things. The first one is near term, short term future. That is what will happen to this company in next 3 to 5 years. And then long term future, what will happen to this company next 10 to 20 years. Beyond it, it becomes very difficult to even think what will happen to a company, right? 15-20 years is a very long period. If you can get revenue visibility for next 15-20 years, it is amazing for a company, right? So I need long term vision as well as short term vision. So for long term, they've started to enter into long term contracts, and for short term, management have given their guidelines. We'll be talking about that. Let's talk about management guidelines first. See, currently their product portfolio is around 200 products. Now they are saying we'll be adding 90 more products. That is, we'll be offering in future around 300 products. Our EBITDA margins for these products are going to be around 25 to 30%, and this is huge. Third thing, whatever production capacity they need to produce these extra products and increase the current production, they already have made some capital investment for that. They've one land available at like one of the production location, and they've also acquired another land that is 120 acres in size. So there is sufficient land available for them to set up new factories. Firstly, secondly, management is saying we are planning capex around 3000 to 3500 crores for next 3 to 5 years, right? This is huge. Current turnover of the company is 5000 crore. So this is huge. If you see 5-10 years back, their capex was around 50 crores. From 50 crores, they've reached to like planning the capacity or the capex to be around 3500 crores per year. This is huge. Management is saying our turnover, that is currently around 5000 crores, is expected to increase by 3x. That is, it will become 15,000 crore by 26-27. And if turnover is increasing by 3x approximately, average of 2.5 and 3.5, we expect the profit to increase around 3 to 4 times. That is, my profits will be somewhere around 1800 crores. So my profit margins will be more than 10, 12%, 13%. Right? So why this is happening? Your turnover is expanding, your profit is expanding at a much faster pace because you have already established some systems in place. That operating leverage is coming into play, right? More on this operating leverage in next 2 minutes, but this is giving me visibility for next 3 to 5 years. Now, what about long-term plans? The company is signing multi-year long-term contracts with global players. Recently, one contract got cancelled, but there are still two more contracts, and companies actively looking for such type of contracts to like manufacture chemicals or to do research for other global players. So the first contract is worth rupees 10,000 crores. Their current 1 year sales is 5,000 crores, and they already have a contract in hand that will bring them 10,000 crores rupees of sales. This contract, this amount of chemicals is to be delivered in next 20 years. So on an average, it will be contributing around 200 crores to 500 crores on an average in its sale each year. That is around 8 to 10% of sales is coming from this contract, right? And the good thing is the return on capital employed is going to be around 30% on this contract. It's huge, right? And see, to establish facilities for such big billion-dollar projects, what you need is lots of capex. And for capex, you need lots of money. And this money can be sourced from external sources, like you can ask equity holders or you can take a loan. But what company is smartly doing is they are saying, sir, if you want us to manufacture this for you, if we should have some production capacity. So we will start a plant just to deliver you this service. But for that, we need money. So whatever payments you are going to do us in future, just pay a small amount of it in the form of like an advance. So they have taken advance from customer. They will sell, produce and sell like they've taken advance from the customer. They'll create plant and the production capacity from that advance. They will create goods from that advance and then they'll sell it to the customer and then will generate 30% of return on that. Isn't it great? Right? Similarly, for this contract, this is a 900 crore contract for next 10 years, and return on capital employed is expected to be around 20% on this. The contract is smaller in size, but still 900 crores is no joke. Okay, now let us move ahead and talk about what other things the company is doing. So we have already seen they are expanding into toluene chain now. Along with it, they are looking for opportunities in pharma sector. They are trying to scale up that. They are looking for like high growth sectors, like they are willing to produce chemicals for EVs, batteries, battery chemicals, renewable sources, like synthetic foods, all these things. So the company is very well rooted from like what it is currently doing, but is heading towards a good direction. They've specifically said we are only focusing on high growth sectors. That is, we want more tailwinds, right? We want to make our both the businesses star business. So star business, that BCG metrics, right? Now let us talk about their financials, and this is where it gets really interesting. This is 2012 and this is 2021. So it is like this. Okay. Look at their sales, income from operations. Look at their income from operations from 1673 crores to 5000 crores. That is, their sales have grown from 1600 crores to 5000 crores. Almost 3x growth in sales. Look at their EBITDAs now. That operating leverage is coming into play. Profits have expanded from almost 250 crores to 1000 crores. That is, their profits have expanded by 4x. They are becoming bigger and their profit margins are increasing. Look at their reserves and surplus from 500 crores that have increased to almost 3500 crores. So reserves and surplus have expanded 7 times. Their net worth have expanded 6 times. Look at their debt from almost 600 crores debt. They are now at around 4 times the amount of debt. So sales is increasing by 4 times. Debt have also increased in terms of sales. But this is where it gets interesting. Now look at their fixed assets. So their fixed assets, that is capital work in progress and net fixed assets, is currently around 5000 crores. Historically, it was around 500 crores. So their asset base have grown by 10x, right? And their asset base have grown by 10x. And now they are saying, sir, whatever capital expenditure that we have done in last many years, like this is our current asset base, it is going to increase by 50 to 70%. That is, the capex of 3500 is coming in next 3 years. And you can see what will happen to the sales going ahead. And the good thing about the company is they are very efficiently managing working capital. When the sales was around 1600, 1700 crores, the working capital was only 600 crores. Now the sales have increased 3 times, the working capital have only increased by 2 times. That is, they are very effectively able to manage working capital. Look at their profit margins. EBITDA margins have increased. They are growing in size and increasing EBITDA margins from 15% to around 20%, and net profit margin from 6% to around 11%. And this will become better going ahead in the future. At the same time, company is able to bring down its debt. So currently, like the earlier, the debt equity ratio was equally like 1:1. Now it has came around 0.8. Even if they take some amount of debt, it will again go back to historical level. It will not go beyond a particular level, right? Even if they take some debt right now for the purpose of expansion. So this is financial statements of last 10 years. Now let us talk about their divisions specifically. Look at their revenues. Their revenues have grown by 12% CAGR, combining both the division. You can see specialty chemical is growing much faster rate than competition. The global industry is growing around 6.2%. They are growing around 13%. So it is a high growth business and they are among the best players of the world. So high growth, like growth is high and market share is also really high. So that's why I was calling even the specialty chemical as their star business. And pharma business, it is slightly in the category of that question mark in that BCG metrics, but look at their growth, 20%. Though I understand the asset base, the base is really small, but 20% growth is no joke. We'll see their EBIT margins were also expanding by 12%. If you look at their EBIT margins of pharmaceutical business, it has grown by 44%, right? So pharma is doing really good. That's why they've planned to like separate it and create a new entity of this. So this is the entire analysis of Aarti Industries. I have not discussed in detail the financials, valuations, as well as the competitors, right? But this is just for you to understand how you analyze the company.
Okay. Thank you for watching this video. I hope you found this video really useful. I hope this will help you to make better investment, do better research. And if in case you have any suggestions and comments, please let us know in the comment section below. Or you can reach us at thewallstreetschool.com. Thank you.